Oil prices will hit $100 a barrel. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, a shocking decision out of OPEC is stoking inflation fears and undermining national security as a cartel looks to drive oil prices higher. But will this actually work, or is this a colossal mistake? And this is coming at a time when policymakers are already worried about inflation, suggesting now this will make it worse. But are they wrong? And we have some surprising data out of the manufacturing sector in the U.S. that shows the U.S. economy is in far worse shape than we thought and will lead to more layoffs and lower oil prices. Let's over to Bloomberg, where we picked today's story up with a headline: OPEC Plus makes shock million barrel cut in new inflation risk. Saudi Arabia led the cartel by pledging its own 500,000 barrel a day supply reduction. Fellow members, including Kuwait, the United Arab Emirates, and Algeria, followed suit, while Russia said the production cut it was implementing from March to June would continue till the end of 2023. And OPEC Plus clearly wants higher price, which is no shock, and this is following through on being proactive and ahead of the curve, and is trying to rip oil prices from the grip of macro sentiment. And this is curious because if you look at the macro picture for crude oil and the broad global economy, it's clearly slowing. And that's what you would expect to see happen as the global economy slows down. The demand for energies, particularly crude oil, would actually go down, and so should the price. But one of the challenges when you're in a period of high inflation or coming out of a period of rising inflation is everybody needs higher prices, including the big cartels. So as prices come down, they have only one choice here, and that is to force prices higher. The question we're going to address and answer is this a big mistake for a temporary gain? Top oil analysts issued calls for $100 crude after that decision, with some expecting worldwide supply-demand balances to be in deficit earlier than expected. And that view was confirmed and reflected in the strengthening of Brent's backwardation, where the premium of prompt shipments rises relative to latter supplies in a closely watched signal of tightness. And so when you hear backwardation in the WTI curve, as they're suggesting here, it means that there is a shortage of supply, at least that's what the oil market is saying, and the prices should go higher. But as we get into later in the show, particularly as we hit the manufacturing data, I've got a whole bunch of charts I want to show you of why these calls for $100 in oil don't make any sense at all. In fact, I appear to be just calls for it. And of course, we know OPEC would love for oil to get to $100 a barrel, but I don't think that's likely to happen. And I'm going to show you why here in a little bit. But first, relations between Saudi Arabia and the U.S. have been fraught since last year, when the White House's efforts to cajole the kingdom into pumping more oil fell flat. And Biden made a controversial trip to the region last July, but came away without any commitments on production. And here we can see the issue from a national security perspective is the U.S. ending stocks of crude oil in the Strategic Petroleum Reserve, which were fairly stable for many, many, many years, have come crumbling down as, of course, we know the administration is looking to pull oil out of the Strategic Petroleum Reserve in hopes to bring gas prices down, to bring inflation down, on top of the Fed's efforts to keep the economy from imploding. The question then is this the right move to make here? What do we think about the kingdom's move? Well, let's continue on a little bit further here, as on Sunday, the White House said that the OPEC Plus decision wasn't advisable under current market conditions. The Biden administration also said the U.S. will work with producers and consumers with a focus on gasoline prices for Americans. So what do you think about this decision? I'd really like to know. Is this a failure of the current administration? Is this just a broad failure of U.S. policy by not opening up more reserves to have domestic production? Is this a mistake by Saudi Arabia and OPEC Plus to control prices at a time when the world is saying we actually need lower energy prices? Or maybe you think this is the right move because we need more green energy and this is going to lead to that revolution. I want to know what you think, because the Biden administration is telling us it's about gasoline prices. And I think the real issue here is, from a national security issue, we just don't have the supply we used to have, and it puts us in a dangerous predicament if anything goes wrong. And no surprise, oil prices surged 8% after the OPEC plus blindsided the market with a production cut, sending oil price stocks even higher. Now, many of you didn't even know. How would you take advantage of this? Well, we mentioned this to our Pro CTA subscribers back last week. I want to point this out again because some of you keep asking, how do I use this report, Steve? It's really cool. Where here you can see on 328, and I put out a video to the subscribers so they could see how to use it. And what happened on that day, we saw the machines cover from minus 100% across the board on both the short and the fast and the slow algorithms to 55% long. And I said, look, in the video, this will send oil stock prices likely higher. Take a look at it, run your screens on them. And sure enough, what do we see in today's report? 100% long on the fast algorithm and bind, 35% long on the slow algorithm. And what have we noted? If you take a look at XLE and XOP, since we put out that data point, that report, you'll see them head higher. Look, my friends, it's $30 a month, super easy to use. Find the ones that are at minus 100. When you see them move, run your screens, and if it looks good, then you go. But now, from a perspective of policy, we're already hearing from central bankers that this is moved by OPEC is not one they like. Oil prices jolt compounds inflation puzzle for central bankers who seemingly are already puzzled to begin with. And we began to see some signs of inflation normalizing. And here we go again, another problem. We have strong labor markets, we have consumers who can spend, and now oil prices are coming up. So it's increasingly challenging for central banks. And what you're hearing is from these experts is, hey, this is going to lead to more inflation or persistent inflation because, wow, the consumer is really strong. The labor market is strong, which I'm going to show you is not going to last a whole lot longer. So this move by OPEC is just going to cause consumer prices to stay higher, force the Fed's hand to keep cutting or raising rates and continue to unwind the balance sheet at a time the banking system seemingly can't handle a whole lot more of it. And the inflationary pressures are still there, again, with no signs from these experts it can come down. If we don't see a big slowdown in economic growth as a result of these issues in the banking sector, then we've got a new constraint on the global economy, which could mean that inflation remains higher for longer. And again, here we're seeing from more experts, and now we're going to take a look at the Fed, that nobody thinks inflation can come down. And I know many of you agree with that, but we're going to show you some charts here that suggest that inflation is coming down even if OPEC raises prices and it manages to keep them sustainably higher by cutting production here. And even if it works, it's not going to last a whole lot longer than they want. Now here we see from Bullard, James Bullard, saying oil surge might make Fed's job more difficult. Of course it's going to. He said this was a surprise today. Whether it will have a lasting impact is the question. And he's not a voter, but he is very outspoken. Oil prices fluctuate around, he says. It's hard to track exactly. Some of that might feed into inflation and make our job a little more difficult. Well, Bullard, it's not hard to track at all. And yes, it does feed into inflation. In fact, let's head over to the St. Louis Fed database, which, by the way, you're the president of that regional Fed bank. And here we've got crude oil prices, WTI of West Texas Intermediate. And what I want to point out on this chart, about May of 2022, we see a peak in crude oil prices. Here you can see the WTI contracts. And I want you to just note that the price has come down. Now, from an inflation perspective, we care about the rate of change, the year-over-year rate of change specifically. And what we can note, because the peak was in May, and unless we see prices break that from the May peak going higher now, if that happens, then we can see the year-over-year rate of change rise. If it doesn't, we're still going to see a negative year-over-year rate of change in crude oil, here shown in blue. And as we know, that leads just slightly the year-over-year rate of change in gas prices. Now, why do we care about gasoline prices? Well, we might not that much, but the CPI, it really does. And here you can see U.S. regular all formations gas price in blue on a year-over-year rate of change against the CPI, also shown on a year-over-year rate of change. And what do we know? That, of course, WTI leads gas prices, which leads consumer inflation. And so we can note that at the current level of gas prices on a year-over-year rate of change, what this tells us is that inflation should be right at the Fed's 2% target. So all these experts who are saying, look, this is going to lead to more inflation, more persistent inflation, even hearing from James Board, the president of the St. Louis Fed, they should be saying, look, it doesn't matter. And I'm going to show you why when you get to the factory data, this doesn't make a whole lot of difference because the U.S. economy is slowing and we've made the wrong move at the Fed. Of course, he's never going to say that or anyone else. But let's continue on, because now we have some ISM Manufacturing tumbling to the post-COVID lows as employment slumps. And remember, my friends, I warned you this would likely happen, that if we did not see a material pickup in the economy, the layoffs would soon follow. They generally start the manufacturing sector. Remember, we've heard a lot of data out of the services sector saying, look, it's robust, they're hiring, there's strength here, and that's being used now as a proxy for the broad economy, but it's really the manufacturing sector that matters. And let's take a quick look at this snapshot of data. Here we have the Purchasing Managers Index on the manufacturing sector from the Institute of Supply Management. And what do we know? It improved from 47 to 49. So it went from a slight contraction to just an itty bitty contraction here in March. Let's look at employment, which was fairly unchanged. At 49, you're talking just a smidge contraction here, but now down to 46.9, showing that these manufacturers are starting to shed jobs a little bit. And why are they doing that? Well, they should, because look at new orders. You see a bit of a slight contraction at 47, now down to 44. So we're starting to see a material contraction in new orders, which we mentioned this was going to happen due to too much inventory, too high prices, and not enough economic growth to support it all. And now we're seeing it in the data. And notably, what do we see? Prices. This is plateauing as well. We see a slight increase last month, now at 49.2, just a smidge of a contraction. So what we're seeing overall here is a contraction. And actually, this first one is the S&P Global. Here's the ISM one at 47, now at 46, a clear contraction. And what does this mean for crude oil? And does it mean that the OPEC Plus group, that big cartel, is going to be right? Well, I'm going to show you here. They've got it completely wrong. They're trying to push prices up at a time they should be looking to push prices down, because the after effect here of their move is going to be considerably lower crude oil prices. Let's take a look at this chart here where we have the Philly Fed new orders, because we don't have access to the ISM data in the Fed database, and we've got WTI here in red. And I want you to see in periods where the blue is trending lower. Now remember, these are pretty noisy, but generally you see the trend lower, crude oil prices are rising, and then they come down. Here you can see another great example going into the global financial crisis, the trend lower in new orders, crude oil prices rising, and then they come crashing down. Here again, you see this in 2010 through 2013. You notice crude oil prices are rising, new orders are coming down, and eventually crude oil prices have to fall. We're seeing this happen again right now, my friends, is new order demand is falling. And now what are we seeing is OPEC trying to drive prices higher here, and it's going to be a colossal mistake, because they're going to push the global economy down by driving prices higher in energy. They don't know it, and it's not only is it going to lead to lower energy prices and lower crude oil prices, but lower inflation. And here we can see, using that same chart from the Phillies Fed, now overlaying the consumer price index, when you see new orders head lower, eventually the red line, the consumer price index, eventually falls. So now we know we have more data, not only validating that gasoline prices are suggesting that inflation is coming down and the economy is slowing, but the manufacturing sector is starting to validate it. You put those two together with how oil prices, and next thing you know, you've got everything you need to see a recession and much lower oil prices. And for the cartel, well, maybe that's not the news they want. It could cause a lot of problems with them. And with that, I'm Steve Van Meter. Thanks for watching. Thanks for being fans. Bye now.